What is up, guys? Back with another video. Nice and chilly outside. About to get in the 911. About to head and work and check out what's going on. Stock market's closed today in the morning for President Carter. Bitcoin's dropping down. All the stocks aren't trading, so don't have to worry about that today. And November job numbers were released yesterday or 2 days ago, and they were good, so everybody's concerned about inflation again. All right, it doesn't look like much happened, but it's 2:02, and the last time you saw me filming, I think it was around 10. So Thursdays I have a meeting with my employees, so I didn't film much today because I did my meeting while I was driving to work, and then I went in Barnes & Noble and I worked for a while. Well, nothing's new with me. What's new with you guys? I don't know what the heck I'm doing. I'm tired. My eyes hurt from looking at screens. I'm ready to just like go throw a football in a field or something. All right, guys, we came home and ate. Say what's up, Bowser. Say hi. Now we're heading back to the 911 because we got other places to go and other things to do. I gotta turn on my fireplace. Gotta have the fireplace on. All right, so if you guys aren't aware, I had rentals at one point. Now I don't, and I just have some funds. Part of them are invested in quantum stocks, and then the other part are invested in SCHD, which produces a small income. It only produces a 3.4 or 3.6% yield. So $1 million, you'll only get $36,000 a year if you invested $1 million. So I'm trying to figure out, is there another way to increase the income? But the income needs to grow every single year more than the rate of inflation. So rental properties can do that because you can raise the rent. But you have to raise the rent every year. And you have to also make sure that your certain variables don't go up, like insurance and things like that. That was one of the reasons why I got out of the rentals I had, but mine were different. They were in an area that was prone to flooding, and it's more about that in another video. Today we're trying to figure out how can we have a passive investment style, and this could even be in addition to real estate. If you already have like a rental property, and I'm not talking about people that are big time with multifamily. I'm talking about smaller. We're just trying to figure out how can we cover our annual expenses by investing money, and in a passive way that we can hand to our wife and kids and they can just continue on with it. All right, guys, so what I did, this is Simply Safe Dividends. This is what I use to like figure out how much income I'll have from the money I have invested. So this isn't real right here, this $1 million. This is fake. I made this for just to show you guys. So what I want to show you is that this is SCHD only. So SCHD, hopefully, I'm going to make another video for people that haven't like invested at all and don't know what these tickers are, like SCHD or VOO, and they don't know where they would even enter them in and how they would buy them. I'm going to make a video just basic stuff, you know, like, but basically SCHD is an ETF and it holds a basket of stocks. Now, this is a fake portfolio with $1 million in SCHD, and you can see here it's going to give us 3.64%. So it's going to give us $36,000 a year in income. And then this is how much it's going to grow every single year. So on average, in the last 5 years, every year, this income is going to grow by 11.6%. So that's more than the rate of inflation. See, so this is how it's going to grow. And by 2035, we should have $157,000 a year in income. And that's not investing any more money. That's just reinvesting the dividend, so it buys more shares and the income grows over time. Now, people in the dividend investing space, they always talk about like JEPI, JEPQ, QYLD, RYLD. Now, these are income funds. These income funds produce higher income. So I made a portfolio with JEPI only. You can see here, look, same amount of money. I know it's a little bit more because it's hard to get it exactly at $1 million. I didn't do the math. I just like typed the shares in. But you can see here, $73,000 a year in income. So at first glance, you're like, dude, I'm going 100% JEPI. JEPI's going to give me 100 or 73,000 a year in income. Look at the dividend yield, 7%. But you're not. There's a couple things I want to go over. That's what I want to show you guys because I'm figuring this out for myself. So you see here, it's like, wow, it actually in 10 years it has more income coming in than SCHD, and it's like, how is that if the dividend doesn't grow? Well, it's going up because the dividend's being reinvested in buying more shares. So if you forever reinvest the dividend and it buys more shares, the income will continue to grow. But here's the thing. People never talk about this stuff online on YouTube videos. This yield isn't real. I'm in a 37% tax bracket. Okay? So I'm going to receive the dividend yield this minus 37%. So that's why I want to go ahead and show on the screen like the stuff that I looked at. I just want to kind of explain it to you guys and show you guys why I am mainly investing in SCHD. So I'm going to go ahead and throw up the little charts I have. All right, so the very first thing I want to say is this is not financial advice. This is me personally just giving you access to my own personal thoughts and honestly worries of how I'm going to produce income for myself and my family in a safe way that's passive. So what I wanted to first do was I wanted to figure out what is the yield of JEPI after taxes? What is the yield of SCHD after taxes? So you can see here using ChatGPT, SCHD's after-tax yield is 2.88. JEPI's after-tax yield is 4.62. Okay, so keep in mind, SCHD's yield grows every single year. The average in 5 years is 11.6% a year. JEPI's yield does not grow. So I made this chart to show if you invest in SCHD, and then you have another account that invests in JEPI, just only JEPI, you can see here the red line is JEPI. So you're going to start off with a much higher income. You're going to be at a higher yield. This is the after-tax yield. So if you look on the left side, that's the after-tax yield. So you see the starting yield for JEPI is 4.8 something. The starting yield for SCHD is below 3. But you can see looking at this chart that with the growth of SCHD's yield, within about 4 years, you hit the JEPI yield. And then you start to surpass it. And it really surpasses it when you factor in the purchasing power of JEPI decreasing. Then you can see here, it's like, when would it be good for you to have JEPI? Like if you needed income immediately and you can't wait, you can't wait for the income or the yield to grow over time. And the other thing would be if you're in like a really low tax bracket, because this yield is taxed at ordinary income. So you can see here on the chart, the starting yield after tax, 2.88 for SCHD. That's after tax. But keep in mind, that's after my 20% tax because I'm in a higher tax bracket. So my tax on qualified dividends is the highest, 20%. If you're in a really low tax bracket, it can even be 0, I believe. And then look at the annual growth rate of the dividend. That's like the past 5 years of SCHD. It's 11.6%. And then JEPI's yield, the starting yield after tax, after my 37% tax, you might be in a lower tax bracket, it's only 4.62%. So you see the SCHD yield continues to grow, and it doesn't take very long before it surpasses JEPI's yield. So for me, it's kind of pointless to have JEPI. And here you can see what I'm describing. The yield, SCHD's yield, see look, year 5, it's already at 5. So by year 5, you've already passed JEPI's after-tax yield with SCHD's after-tax yield. I like to look at after-tax so I can see like what actual money I'm actually getting. So I'm not just like wooed by the original yield because I am in a high tax bracket. So the taxes for me make a huge impact. But look, year 10, the SCHD after-tax yield is already almost 9%. And JEPI's is still just flat, and who knows, maybe it'll even decline. So for me, I've come to the conclusion that I don't really want to hold JEPI because I want to have dividend income that grows annually more than the rate of inflation and has tax benefits. So for me, SCHD or other qualified dividends or dividend ETFs work best. But this doesn't say that I don't want to hold the S&P 500 or VGT. So I'm going to make a case for those in another video. Because that's my little secret weapon is my SCHD with VGT. Those two combined have actually beat the S&P 500 every single year for 10 years. If you don't believe me, use Portfolio Visualizer and backtest it. SCHD versus VGT. Okay, so this chart is representing SCHD versus the S&P 500 over the next 10 years. And ChatGPT used the past growth rates and annual rates of return to kind of put this together and see how they could grow over the next 10 years. If you see, the blue line is SCHD, that's the portfolio value, and the red line is the S&P 500 portfolio value. Now keep in mind, there's no guarantee that it's going to go this way, because for example, Pfizer is one of the largest holdings of SCHD, or Amgen or AbbVie. We don't know, maybe those companies grew massively the past 10 years and they may not grow that way in the next 10 years. And the S&P 500 holdings might. Do you know what I mean? So this is just a fake projection. But what I'm trying to demonstrate is the green line is the income, the dividend income from SCHD. And the yellow line is the income from the S&P 500. So what I'm trying to show is that if you want to have, like in real estate, we have what's called the IRR, the internal rate of return. That's like depreciation, the appreciation of the house, and the cash flow. So when I look at like an ETF, I'm looking at the appreciation of the portfolio, like the actual value of the principal that I invested, and then I'm looking at the cash flow I'm receiving. So keep in mind though, this is with SCHD's dividends reinvested. It beats the S&P 500, but you also have that income if you need. All right, guys, I got to take a little break from that dividend investing stuff. Do you like the movie? My son's playing basketball out front. I'm going to go out there for a little bit. Michael Jordan versus LeBron James. I'm Jordan. Come on, hustle, hustle. I gotta hurry up. I'm gonna be late to get. Once I get this in. Oh! Steph Curry. Little Anthony Edwards. Oh! Oh! If I shoot from where? No! Oh! Money shot. You win because it was the first one to make it wins. Oh! All right, I gotta get going. Woo! Yeah! Oh! I was blocking it with my head. Good shot. I love you, buddy. I'll see you later. All right. All right, guys. I shouldn't be out here. Cow, I'm out of shape. Love you, dude. I'll see you in a little bit. Oh, I gotta get something. See you, buddy. Love you. I gotta get this mat and this towel. I gotta go pick him up from rowing. All right, let's fire this bad boy up. I'm thirsty. I don't have any water. All right, guys, let's get dialed in. Icy cold out here. I got the windows down, a t-shirt on, and the turbo's ready to roll. Here's the Porsche dealer. So you guys can see, looking at that chart, why I'm interested in SCHD. Its past performance was good, but we have no idea what the future performance is going to be. And this is not financial advice, by the way. I'm just saying. But if you look, when you look at that chart, if you're like, oh, SCHD beat the S&P 500, those are past numbers. So don't go off that. Don't think if you're like in your 20s or 30s, whatever, that you should be buying SCHD instead of VOO, because that'd be a bad move. I don't think I would. I would just dollar cost average VOO, S&P 500, because that's going to outperform SCHD, I guarantee it. Well, I don't guarantee it, but it's not financial advice. I'm just saying, if my son said, what should I do? I'd be like, dude, just dollar cost average the S&P 500, get a nice little foundation. Once you got your little foundation and your Roth, and you maxed your Roth out at least, like your $6,000, whatever, depending on your income, then start playing around, get crypto, whatever it is you want. You know what I mean? But make sure you get your little foundation going every year. get your Roth maxed out, and then get into a taxable account and start adding in there. I know guys have had like crazy winnings with crypto. I have too in the past, but I'm saying be careful of that confirmation bias, because you can win and then you can think you're just going to win all the time. You know what I mean? But it doesn't always happen. It can. I'm just saying. I've had multiple wins, you know? Like I had, back in the day, Shiba Inu, 13,000 become hundreds of thousands of dollars. I've had the Quantum, I had 20,000 become 200,000. So it can happen. I'm just saying it's not like it happens all the time. You know what I mean? It can also go the other way multiple times, over and over and over, which I've had happen too. I've lost lots of money. I lost lots of money with not paying attention to confirmation bias after the Shiba win, and I got into all kinds of weird coins like Kishu and S-Dog, Husky. I'm sure you guys remember them. I got into all those kinds thinking it was going to be another Shiba. I'm not trying to be Mr. Fearmonger, because I'm not like that at all. I like thinking about abundance and things that grow and making money. I'm just saying, get the foundation set up. You'll feel so much better if you're like, all right, I got my nest egg, I got my foundation, I got my emergency fund, I don't have any debt. Because you're going to be so stressed out if you're putting all your money in crypto and you've got tons of student loans and other debts. And I don't know about student loans. Maybe don't pay those off. Maybe the government will forgive them. I don't know. But you get what I'm saying. Just, I wouldn't put like everything into the craziest thing. Unless you're sick and tired of being sick and tired, because I've done that before, and you're just like, I'm going all out, Hail Mary, I don't even care what happens. Like, you're like, I don't care if I lose it, I'm going balls to the wall. Because you can do that. Raptor R. I think that thing's got 1,000 horsepower or something. I could be wrong about that, but not 1,000. 800, 700. I don't know why I said 1,000. Unless it does, leave a comment, I don't know. See, for me, what I want is, what makes me feel like a baller, what makes me feel like the big baller, is knowing I got my regular bills covered by passive income. That makes me feel like I am just, it makes me feel like I'm driving around in an Aventador. Put me in a Kia and pay my bills. And I am the Mac Daddy. That's what I want. I don't know if you guys are familiar with R. Buckminster Fuller. I don't think I've ever said this on the channel. But he is... You ever been at a playground and you seen those like, there's a Challenger up there, Hellcat. You ever been at a playground and you seen those like dome-shaped play things, and they're like, the dome is made of triangles, and that's the shape? Just look him up. He was an architect. He's the one who patented that design. R. Buckminster Fuller. Mr. Buckminster Fuller, I don't know which name, which word's his name, first, last name, can't remember. He's the one who figured out what wealth, or he like coined, I guess, the phrase of like what wealth is, like what being wealthy is. And it's how many days forward you can sustain. I think he said, I'm trying to remember the way he worded it. He said, wealth is the ability for a person to survive a certain amount of days forward. So like however many days forward you can survive, that's how wealthy you are. So if you have passive income that covers your bills, you're wealthy. You don't have to have a mansion, you don't have to have a Lamborghini. If you can not trade your time and you can go forward an infinite number of days in your life without trading your time, you are wealthy. It doesn't come down to what you have, a fancy watch or car or anything like that. So that's why you gotta be careful listening to some guru online that's got a bunch of Lambos. How many days forward can he survive? Do you know what I'm saying? How many days forward can he survive without trading his time? Unless he's like a real estate investor, or he's got some kind of passive income from dividends, or maybe cash flow from a business. I'm not saying that having those things doesn't make him a guru or make him knowledgeable. I'm just saying, I'm not knocking the material things. I'm saying don't think that's what you need to be considered wealthy. Because if you add all those things, according to R. Buckminster Fuller's definition of wealth, it's going to be way harder for you to survive a lot of days forward with all that crap than it is without it. So think long and hard about it before you start adding all these things to your life. Honestly, I'll be dead honest with you guys. I kind of regret the 993 purchase because I'm getting so deep back into my dividend investing and passive income mindset that I'm like, I know I'm not going to regret it once I have it and I drive it, but I'm just kind of like, damn, that's money that I'm like thinking about the income it could have produced. You know what I mean? And I'm also thinking about the money it's going to take out of my pocket. You know, getting the lift, getting the insurance, it's a liability. It's not really an asset. But maybe over time it'll prove to be an asset. I don't know. But what I'm getting at is I bought it as an emotional buy to drive it and enjoy it, and really for the channel too. So I don't truly regret it, but I regret it in the sense when I think about the dividend income it could have produced. But check that out, our book, Mr. Fuller, Definition of Wealth. I don't know why I remembered that, but I read it somewhere a long time ago or something. I think maybe Robert Kiyosaki said it on like a podcast or something, and I just remembered it. All right, guys, I'm picking my buddy up. All right, guys, we're headed back, driving back. I wanted to show you guys the top 10 holdings of SCHD, because these top 10 holdings make up 40% of SCHD. These are the top ones I think that boost the yield, honestly. Because without these, because these are all slightly higher yielding, I'm pretty sure without these the yield wouldn't be in the mid threes, because a lot of the other stocks in SCHD have lower yields but high growth rates. Thanks for watching, guys. I just wanted to make this video just to kind of show the difference between the yields of JEPI and SCHD, because I know in past videos I've mentioned that I might buy JEPI, or I did buy JEPI, then I sold it. After doing my own research and some due diligence, I figured out that after-tax yield, it's pointless for me to own JEPI, especially when the SCHD yield grows every year, and it takes 5 years for it to surpass JEPI, and then it continues on, and JEPI's pretty much going to stay the same, the yield. But that's because I'm in a high tax bracket. Maybe it's different for someone in a lower tax bracket. You have to do your own calculations. But you can use ChatGPT. It's helpful. So I do love SCHD. I do like the quantum for long term. That's my Hail Mary. And I have a little bit of cryptocurrency for my Hail Mary too. But my core holding is SCHD. But I have a second core holding that I never really talked that much about with you guys. I've mentioned it, but it's VGT. VGT is for tech. It's Vanguard's tech ETF, which I like a lot. It's similar to QQQ. I choose to hold VGT because I like Vanguard. The expense ratio is slightly lower, and it has a little bit more small and mid-cap tech. But QQQ is great. But if I was to buy QQQ, I would buy QQQM. That actually has a lower expense ratio, and it's the same. It's pretty much the same ETF. It just has less money in it. But look that up if you don't know what it is. QQQM. That's what I used to buy. But QQQ and QQQM, they have the same stocks. They both have Amazon, so VGT doesn't. VGT, like 40% of it's Microsoft and Apple, I believe. It's got some Nvidia, PayPal. So I like VGT, but my secret weapon is SCHD and VGT. Those two combined, if you backtest them using Portfolio Visualizer, you'll see that they beat the S&P 500 every single year for 10 years. I might have mentioned that on this video, I can't remember. If I did, I recorded the clip like hours ago, so it might sound like I'm repeating the same thing over and over. But maybe someone didn't catch it, so if I said it again, who knows. So a nice setup, I think, is SCHD, VOO, and VGT. And your core, if you're young, just be VOO. Maybe don't even have the SCHD. And as you get older, start to take off some profits off VOO and VGT and put them into SCHD or some other dividend income producing fund. But when you're young, you don't want to have the tax drag of dividends. It's better to let the money compound. I should be doing that too. I'm still young. It's just I have this like kind of fear mindset deep down where I want to make sure I have some kind of income building up, or I want to see it every day increasing. I just like that. They say like men only need peace and progress. I feel like they'll see the dividend progress and go up see the income increase every year or every day, every month. I like it. But subscribe to the channel, guys. I'll see you on the next video. Thanks for watching.